In this video, traders, we're going to look at trading clues from a large daily range. Stay tuned. Hey traders, warm welcome to you. All right, so if you're new here, welcome to the channel. If you're a subscriber, I appreciate your support. Okay, so we are talking about trading clues from different parts of the trade. We've talked about trading clues from the open. Go and check that video out. We talked about trading clues from the close. Go and check that video out. Now we're talking about trading clues from a large daily range. So what do I mean by that? So we have a scenario like this. And by the way, guys, daily range is, we're going to take phases of the market. So if we're looking at currencies, we're going to look at the London session, the Asian session, the New York session, all the way around London, New York, and then Asian session. If we're equities, it's obviously the bell, opening bell, closing bell, whatever it may be, that's the main session for the instrument that you're trading. Okay, and I recognize that there's a bit of a blend between the two. Sometimes you've got some pre-market action if you're looking at a stock and some aftermarket, but generally speaking, there's going to be an open or close. And we're looking at that. That's the specific point now. We're going to go further into overnight ranges in another video. But for this one, we're looking at the large daily kind of regular trading hours if we were talking stocks, or London session if we're talking FX, Asian session, those splits if we're talking currencies. Right. So what a trade includes from large daily range. First of all, we'll look at the position. So crucial. I bang on about this so much, and I know the subscribers are getting bored of this, saying, I get it. But the position is so crucial, okay? Let me just recap on this, because I feel this is what everyone makes the mistake at. Hold my hands up as well, made this mistake, which is why I bang on about it so much. You know, if we've got this, let's say this is a very rough 10-day chart, right? If we've got a big range here, okay, we've got, wow, I've got a massive range, but it's in that position of the 10 days high was here, 10 days low was there. Who do you think cares about it? Only the very people who are trading very short term in this window. The people who are trading longer term couldn't care less about all this, because it's not taking out highs, not taking out lows. It's probably not even on their radar. But now you have a scenario where the daily range is this up here, okay, say it's the range, and we're at fresh all-time highs, and there's loads of other things going on. Who cares now? Yes, not only the people who are day trading it, but also all of these people now care, because they're either on side, and everyone cares if they're making money, or they're off side, and of course everyone cares if they're losing money. Right, let's just wipe some of this off and let's start again. So, position is so key. We need to see a decent position. There's no point having a daily range that's large and it's in the middle of nothing. You know, if it's in the middle of stuff that's not very exciting whatsoever. So, position, check. We want to see it's in fresh territory. So fresh territory, i.e. we're above that high, we're below that high. Right, next one, relative to normal. So, okay, large daily range isn't so good on its own, but what do we define as large? This is again something that's so important, whatever kind of price action strategy we're using. Relative to normal is, okay, so I've got a 100 pip range. Does that sound like a lot? Yeah, it sounds like a lot. What about 1,000 pip? 1,000 pip, oh, it sounds like an awful lot. But what about if for the last 30 days we're in a 2,000 pip range? Is that a large range now? No. Yes, it's large relative to perhaps euro, US dollar, perhaps other pairs, but whatever this pair may be, this hypothetical pair we're talking about, is that normal? Well, actually, no, it's less than normal. So we've got to look at not only normal relative to the currency pair that we're trading, or the equity that we're trading, the commodity that we're trading. So let's say we get 2% move. Is that how we've had 2% move in the past week? Oh, we've had 1% move really in the past week. So this is kind of twice normal, if you like. Okay, but then what about broader? So while we're going through a phase of expanded volatility, so let's just put some kind of maths to this, or some numbers. Let's imagine that we'd had, for the last year, our average daily range was 1%. Okay, now, for the past 30 days, the average range has been 2%. Now, we've seen an average daily range, or the daily range today was 3%. What do you think is happening? Well, we're having a lot of interest coming in, a lot of news flow must be coming in. Something's happening that's causing people to kind of put their money where their mouth is and start to execute with a little bit more urgency. And now that's accelerating. So yes, we're interested because supply demand imbalance could get huge, because not only is it outside of the normal for the small window that we not normally look at, which is like 30 days, 7 days, whatever it may be, but also from the whole year. We're in a new phase of the market. We're in a new, interesting, exciting time, especially as kind of shorter term traders, whether we are swinging or day trading, something to get our teeth stuck into. So relative to normal is so important. And again, we look at the first step of this, guys, just to say, okay, what's the daily range? Okay, daily range is 100 pips. How is that relative to the past 5 days? That's the best first starting point, if you like. If it's really huge, okay, now we're interested, because now someone's moving money about, and we could get some juice out of this. So relative to normal. So bear in mind now, guys, we're just going through a filtering process. In a second, we'll talk about how this is useful. Number 3 is key levels. So how has the price responded to key levels? So let's say we've had kind of big ranges. This is a big range, lots of market. What's been a key level? Because key levels during big ranges have more weight than key levels during nothing ranges. If this market is ripped up really super aggressively, stop like that brick wall and come down aggressively, and you can imagine like a big swathe of people running backwards and forwards and slamming up to a wall, back again, banging up against the wall. You know, if this level's held twice and we've had supply demand imbalance that's severe, then you can bet that if we start to creep back up here overnight, you want to be smacking that short, because if this is held when we've had a big steam train run up to it, it's just gone clunk and drop back, and again clunk, drop back. Now obviously I don't think we'd have a pullback here, but let's say we closed here and we kind of drifted up overnight, and we're just sort of doing a little bit of work above that on low volume overnight session or thin hour session. Let's say if we're trading sterling, GBP, and it's 2 o'clock in the morning or something, and it was just drifting, there's no volume, you think that's going to hold? You think that's going to stay there? Probably not, because whoever was smacking that and stopping that big freight train there, as soon as they wake up next morning or as soon as they start shifting money around, is more than likely going to be heavy on the supply side of that. So the response to those key levels is so important. And then also the other thing, guys, the next day is using, let's say we are day trading, let's say we are swing trading and bringing a position based on a good day trade. Even things like, where has it pulled back to? Okay, where's it pulled back to? Right, that might be a place to initiate a long the next day. I might want to align myself with a long the next day. So let's go back to the initial process. So the position, where's the position? If the position is stretched out, then we need to take it into account. We need to say, okay, we're above a key level, or above like a weekly range or a monthly range, or below a monthly range. Now I'm interested. Now I'm interested to see how price responds to it. I'm going to follow this move. If it's strong, if it's holding, if it's had good stretch above that, then I'm going to assume then that people are seeing this fresh territory as value, and so I'm going to ride their coattails for a further move. And again, let's not go into intricacies. This is not a video about really dialing down into specific rules. This is keeping it broad. Then we're going to say relative to normal. Okay, so we're now above, let's say we're above that weekly range, and we've got a big range. How useful is that? Well, big range means to us that people are participating. If there's an unusual range, it means that people are participating, which means there's likely to be more weight for our setups. Now, I'm not going to go into, let's not go into intricacies here about whether we're going to mean revert, whether we're going to follow the trend. But what we want to say is that when our setup occurs, more weight is now added to it if we've got the position ticked, if we've got relative to normal ticked. And if we've got, and then really the key levels is using that as part of our setup. So if our setup might be, okay, we've had a downtrend here, we're outside of our weekly range, we push back up, we've got this huge level, I want to align myself short because we're outside of the range and whatever it may be, this key levels hold. Where do you think the nicest place to hit it short is going to be? Yeah, it's going to be if we do some work above that, just because we've got the boxes ticked, we're bigger than normal, position's good, and the response to key levels. So anyway, guys, we're just kind of planting the seeds and kind of doing a general overview of how useful our large daily ranges and some of the clues that we can get from it. And those two specifically are so important. They're relatively simple, but overlooked by a lot of people who kind of see stuff and go, well, that's really, really good. But, like I say, if it's in the wrong position, it's worthless. And say relative to normal, it looks big, but how is it relative to, maybe we just went through a kind of lower contracted volatility. We've been normal's been 3%, and the last week's just been 1%, and it's up 3% all of a sudden. Well, what's that? Okay, it's a little bit more than the last 5 days, but we're now back to normal, if you like, based on the prior 30 days, 50 days, 90 days trade. So it's always putting things into perspective that yields results for trading. All right, guys, take care. Appreciate your support if you are a subscriber, and of course, if you like the video, a thumbs up appreciated too. Take care. Bye bye.